Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. The S&P 500 smashes a historic high, but a crisis looms as the rally is dangerously propped up by just a few tech giants. Is this a bull trap in the making? Second, Amazon's layoff bombshell, 30,000 jobs cut as the AI war on white-collar work begins. This isn't just about cost-cutting, it's a historic reversal. Is your job next? And how does this massive gamble threaten to rewrite the rules for the entire S&P 500? Finally, Qualcomm versus Nvidia. The $6.7 trillion AI chip war ignites, threatening Nvidia's trillion-dollar kingdom. Qualcomm's stock just skyrocketed 11% after its surprise attack. Will this shadow play finally crack the AI monopoly and trigger a profit margin bloodbath? Breaking news rocks. Wall Street, a historic milestone has been reached as the S&P 500 crosses the 6,800 barrier for the first time in market history, closing at 6,875.16. Meanwhile, the Nasdaq surged 1.86% to 23,637.46, fueled by optimism around Federal Reserve rate cuts and promising trade negotiations. Why is this significant? The market's exuberance is rooted in the anticipation of a quarter-point rate cut by the Federal Reserve, creating a conducive environment for equities. This anticipation, coupled with progress in US-China trade talks, has alleviated some geopolitical tensions, making investors bullish on the technology sector, which is heavily reliant on these dynamics. This optimism has been further bolstered by the upcoming earnings reports from mega-cap technology companies, the so-called Magnificent Seven, including Microsoft, Alphabet, and Meta, which are expected to showcase their prowess in monetizing artificial intelligence advancements. However, be cautious. While the indices are climbing, inflation remains persistently above the Fed's target, signaling potential volatility if market expectations aren't met. Furthermore, the rally is heavily concentrated in tech giants, indicating that broader market confidence might not be as robust as it seems. In today's standout sector, technology led the charge, with Apple rising 2% and Microsoft hitting new highs. Nvidia also rallied strongly, contributing to the semiconductor index, SOX, surging 1.5%, outpacing the broader market. This reflects investor confidence in tech's growth trajectory, particularly in artificial intelligence infrastructure. Here's what to watch closely. First, the Federal Reserve's rate decision on October 29, if they cut rates as expected. Monitor whether the Nasdaq can maintain its momentum above 23,500. Second, focus on earnings from the tech giants. If Microsoft or Alphabet miss expectations, it could trigger a sell-off, testing the Nasdaq support level at 23,000. Additionally, keep an eye on the VIX volatility index, which, if it rises above 20, could indicate a shift in market sentiment towards risk aversion. Now let's take a closer look at the specific stories driving today's action. The story begins with a decision that caught everyone by surprise. Amazon is preparing to announce its largest corporate job cuts in company history, with as many as 30,000 employees at risk. The layoffs are expected to begin via email, spanning almost every business unit inside the retail and tech giant. This isn't just another round of trimming. This would represent the single biggest job cut across the entire tech industry since at least 2020. For context, Amazon has roughly 350,000 corporate employees, meaning this move could impact a significant portion of its white-collar workforce. Naturally, the first question is whether this signals a recession. It's crucial, though, to distinguish between a tech sector adjustment and a broad economic downturn. Interestingly enough, even with these massive cuts, overall layoff announcements across the US have actually been decreasing. For example, the Challenger job cut report showed a significant drop in announced cuts recently. So it seems this is less about the entire economy being in trouble and more about the tech industry correcting its pandemic-era overhiring. But that's not the whole picture. The real turning point is understanding this is part of a broader campaign by CEO Andy Jassy to fundamentally reshape the company. He's on the record aiming to remove layers and flatten organizations. This isn't just an internal cleanup. It's also a defensive strategy. Amazon is building a war chest to fight an intensifying battle against rapidly expanding Chinese e-commerce rivals like Temu and Shein. These platforms have completely disrupted the market in the US and Europe with their ultra-low prices. This signals an escalation of the global retail price war. For us as consumers, this can be disinflationary, meaning downward pressure on the prices of goods. For Amazon, it's an existential threat that requires them to become leaner and more aggressive. This is where the situation takes a more complex turn, because the driving force behind this massive shift is the integration of artificial intelligence. Believe it or not, we are witnessing a historic reversal. For decades, job displacement from technology primarily hit blue-collar manufacturing jobs. Research from the Economic Policy Institute shows that in the past, white-collar workers were far safer, but that's changing. Generative AI is uniquely skilled at automating tasks that were once the exclusive domain of knowledge workers, tasks involving expertise, analysis, and natural language. McKinsey's research is stunning on this. They estimate that generative AI could automate tasks that take up 60 to 70% of a typical employee's time. So when Amazon talks about AI, they're not talking about robots in a warehouse. They're talking about AI reshaping the very nature of corporate office work. This isn't speculation. In a direct memo to staff, Jassy stated that as Amazon embraces generative AI, we will need fewer people doing some of the jobs that are being done today. He then delivered the knockout punch, confirming, "We expect that this will reduce our total corporate workforce." This is the great corporate productivity gamble. By replacing human capital with AI, Amazon is making a massive bet that the productivity gains will be so huge and so immediate that they will more than offset the loss of experienced employees and organizational knowledge. If they are right, it could trigger a boom in corporate profit margins and set a template for the entire S&P 500. But if they're wrong, it could lead to operational chaos and a long-term drag on innovation. These cuts follow more than 27,000 layoffs that have already taken place since 2022, hitting divisions from cloud and stores to communications and devices. While Amazon is the nation's second largest private employer with over 1.5 million workers, the vast majority are in its warehouse network. This new wave is aimed squarely at the corporate heart of the company. So how does this affect your wallet, even if you don't work at Amazon? When a large number of high-paying white-collar jobs are eliminated, it does two things. First, it suppresses wage growth for similar roles across the industry. Second, if the AI productivity bet pays off, the company can produce more with fewer people. Both of these forces are powerfully disinflationary. They push down on inflation. After all, this complicates the job of central banks like the Federal Reserve, which are trying to manage a soft landing based on traditional economic cycles. This, however, is not a cyclical slowdown. It's a structural change driven by technology. The message from one of the world's most powerful corporations is stark. The era of AI-driven workforce reduction is not a distant forecast. For tens of thousands of employees, it is happening right now. So what should we watch for next? First, keep an eye on Amazon's own actions. As a bellwether for global e-commerce, their aggressive cost-cutting might signal an internal belief that future consumer spending will be much weaker than official data suggests. It's a powerful counter-signal that could mean a slowdown in discretionary spending is coming. Second, we need to monitor corporate productivity reports. Will these AI-driven layoffs actually lead to the massive efficiency gains that companies are betting on? The answer will have huge implications for corporate profits in the stock market. Finally, watch the labour market data closely, specifically the difference between what's happening in tech versus the rest of the economy. This will tell us if the AI-driven job transformation is contained or if it's beginning to spread. We were just talking about Amazon's massive gamble on AI to boost productivity and reshape its workforce. Now, let's zoom in on the hardware war that's making it all possible. A new challenger has just entered the ring against AI titan Nvidia, and it's a name, from your smartphone. Qualcomm, the mobile chip giant, just announced it's taking on the data center market, and its stock immediately skyrocketed 11% on the news. This is a direct shot at Nvidia, which has dominated the industry with over 90% market share, driving its valuation past a staggering $4.5 trillion. The prize Qualcomm is fighting for is massive, a market that McKinsey estimates will see nearly $6.7 trillion in capital expenditures by 2030, most of it for AI systems. Now, get this. This AI capital expenditure boom has huge macroeconomic implications. This massive spending on data centers creates a surge in demand for electricity and construction. The International Energy Agency projects that by 2030, data center electricity consumption will more than double, driven almost entirely by AI. This new powerful source of demand could put upward pressure on energy prices and construction costs, creating a sticky floor for inflation and making it much harder for central banks to bring inflation back down to their 2% target. But Qualcomm isn't just copying the playbook, it's making a strategic pivot. While Nvidia's chips are famous for training massive AI models, Qualcomm is targeting AI inference, the actual running of those models, promising lower operating costs and greater power efficiency with its new AI 200 and AI 250 chips. The situation presents a fascinating duality. On one side, you have AI training, which is like the years of intense study a student does to learn a subject, requiring massive computational power. This is where Nvidia's high-end GPUs excel. On the other side, it exposes the need for inference, which is like taking the test using that learned knowledge to answer new questions quickly and efficiently. This requires less raw power, but emphasizes low cost and high efficiency. So the thing is, a separate cost-sensitive ecosystem is now emerging just for inference, and that's the market Qualcomm is aiming for. This maturation of the AI market could be the first real crack in Nvidia's monopoly. This isn't a random bet. A Qualcomm executive framed the move with startling confidence, stating that after proving themselves in other areas, it was pretty easy to scale up to the data center level. This confidence isn't just bravado. It reflects a classic business strategy known as the second mover advantage. By entering the market after Nvidia, Qualcomm has had the chance to observe, learn from the pioneer's successes and missteps, and identify a specific niche power-efficient inference that wasn't being fully served. If this fast follower strategy succeeds, it could prove that the AI chip market isn't a winner-take-all game, potentially changing how investors value market leaders like Nvidia. The company is even offering full liquid-cooled server rack systems that allow as many as 72 chips to act as a single computer, directly matching the scale of offerings from Nvidia and AMD. What really brought this to a head was the next development. The company is weaponizing a key technical specification to gain an edge. Qualcomm has announced its new AI cards will support 768 gigabytes of memory, a figure higher than current offerings from its main competitors. So, what's next? The real focal point to watch is not just market share, but profit margins. Nvidia has enjoyed historically high gross margins, recently peaking near 76%. This incredible profitability has been a major engine for the entire tech sector's stock market performance. Now, with serious competition from Qualcomm and even major cloud companies developing their own in-house chips, we are likely to see the beginning of margin compression for Nvidia. This increased competition threatens a key driver of tech earnings and could force a re-evaluation of how much profit there is to be made across the entire AI value chain. This battle will determine the future profitability of the AI hardware industry.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.